The World Bank has lowered its growth forecast for the Chinese economy this year and next, citing the impact of the Omicron variant and the downturn in the property market. At around 5%, it would be the weakest growth China's seen in over 30 years, aside from 2020. And while other countries are preparing to raise interest rates, China is cutting them, hoping to encourage spending and investment. Seong-woo has the details.
The World Bank now expects China's economic growth this year to come in at an even 8%, a downgrade from the 8.1% it forecast in October and 8.5% back in June. It cites the impact of the Omicron variant and the severe downturn in the property market. And for 2022, it's lowered its forecast from 5.4% to 5.1%, which, aside from 2020, would be the slowest pace of growth since 1990. China was the only major country to avoid an economic contraction in the first year of the pandemic. But this year, it's seen huge layoffs, and stocks have taken a beating in the wake of unprecedented regulatory crackdowns on the tech, education, and entertainment sectors. It's also been held back by antivirus restrictions and an energy crisis. The real estate sector accounts for nearly a third of China's GDP, but major developers are struggling to pay their debts. All this has prompted a policy shift at the People's Bank of China, which recently cut interest rates for the first time in 20 months, hoping to encourage consumer spending and investment. It's also reduced the ratio of assets that banks have to keep on reserve instead of lending out by 0.5 percentage point. But to truly rebalance its economy, the World Bank recommends that China make changes in a number of areas beyond infrastructure and real estate. Economists there say China's economy needs to be led more by the private sector, driven by consumption and services, and less carbon-intensive. They suggest reforms including a more progressive tax system, stronger social safety nets, wider use of carbon pricing, and green finance. Seong-woo, Arirang News.